Hello and welcome back. My name is Scott Heaton. I am your host of Scott Recommends, and today we're back with Matt Bell of My Tax Pro. And today he wanted just to touch real quickly on how is inheritance taxed.
Yeah. Thanks for the question. Um, you know, if let's say your mom and your dad, they pass away. Let's say, they had purchased a home back in, the 1940s. They buy, they buy this home for $50,000. Now, fast forward, they pass away, but that home is worth like $400,000 now. There's this huge gain, right, of the value of this home. So the question is, well, do I have to pay taxes on this giant gain when I sell my parents' home? And the answer to that is it depends, right? So if you sell the home right after they pass away, there's something that's called a step up in cost basis, meaning that the basis, what you purchased the home for, or what your parents purchased it for, is $50,000. That basis gets stepped up to the value of the home on the day that the parents pass away, which in this scenario, let's call it, $400,000. So you have the step up in cost basis. Well, now the basis is, $400,000. You sell the home a week after they pass, and there's no gain, right? But now in a different scenario, let's say you wait a year to sell the home after they pass. You still get that step up in cost basis up to 400,000. Let's say the real estate market does really, really well, and it goes from 400,000 to 450,000. You do have to pay a tax, a capital gain tax, on the increase of the 400 to the 450. And so it depends on when you sell that home. It will depend on whether or not you have to pay taxes on that. Separate from a home, oftentimes people will inherit like a retirement account, like an old 401k or an IRA or something of that nature. All of that money is pre-tax money. And so when you inherit that money, it's never been taxed. And so you have to pay taxes when you make distributions from that account. So it's going to be considered an inherited IRA when you receive it. And there's an RMD, or a required minimum distribution, a specific amount that you have to withdraw every year for 10 years, and you're going to be taxed on that money. Separate from that is if you have like a brokerage account, you just have this stock you buy, or your parents bought Apple stock and they bought it for $10, and then you inherit the account after they pass away. That $10 stock is now worth $100. It's that same step up in cost basis terminology that we'd use for the stock that we would with a house, where there's a step up from $10 up to $100. So when you sell that stock, and there's not that capital gain. So it kind of depends on what account you're inheriting, and that will depend on whether or not there's a step up in cost basis or whether that money will be taxable.
This stuff is sounding more and more familiar all the time, and probably because I'm at that age where a lot of our parents are starting to pass away.
Yeah.
And so in my age demographic, these conversations are happening more and more. And so for those that are looking for maybe a little bit of guidance and some help when it comes to this topic, how do they get a hold of you?
Yeah, so they can give me a call. My number is 352-3396, or they can search us online at my-taxpro.com.
Thanks again.
Yeah.
Great topic. And a great way to potentially maybe avoid some tax deduction or tax debt or
tax liability.
Liability. And there we go. Well, again, Matt, thanks so much. I sure appreciate you dropping by, chatting with me, and look forward to chatting with you next time. Thanks so much for watching. We'll catch you next time.